Hello, and thank you for joining us for this webinar. I'm Dami Koga for Scientific Beta, and today we will be discussing the importance of taking hidden risks into account in factor investing. I'm joined today by Eric Shabani, who is Global Research and Investment Solutions Director at Scientific Beta. Hi Eric, good to see you again.
Thank you, Dami.
So if you follow our webinars, you've certainly heard us speak about the benefits of multi-factor investing. However, despite all of the advantages smart beta strategies can offer investors, it's important that they be aware of some of the implicit risks that they are subjected to. Okay, Eric, so let's get started. How about you tell us what some of these hidden risks are and how exactly do they affect, why are they important for investors?
Okay, risks in general are very important. Unfortunately, the decision on selecting smart beta strategies are often based more on fees, lowest fees, and recent performance. And as a result, the risk implications of smart beta strategies, which often drive this recent performance, are not fully understood. Smart beta strategies are selected to provide exposure, explicit exposure to some well-rewarded factors like value, momentum, low volatility, and so on. These factors provide good risk-adjusted returns over the long term. But these strategies are also exposed to a number of hidden or implicit risks that could be very important in terms of driving short-term performance. So in this presentation today, we would like to focus on three important implicit risks. The risks we will focus on today are the market beta bias, sector risk, and geographical risks. Not only will we look at the impact of these risks, but we will also look at offering risk control options that allow investors to control for these risks and therefore meet their fiduciary responsibility. So, in terms of the importance of looking at these risks, particularly these hidden risks, there are three reasons why it is important to focus on these hidden risks. First of all, misrepresentation of backtests. These hidden risks will have an impact in terms of short-term performance. Investors invest in these strategies for long-term performance, but hidden risks may actually impact the short-term performance. So it's important to understand what those risks are in order to get a better idea of what the recent short-term performance of these strategies are sensitive to. So focusing on these hidden risks is particularly important for the short-term performance. Secondly, misalignment with policy benchmark. Investing in factor strategies may also expose you to some other risks that have interactions with other asset classes in your policy benchmark. So it's also important from a total portfolio point of view to understand what all the risks are when you invest in these strategies. And thirdly, and probably most importantly, is unveiling these hidden risks leads to better governance. Traditionally, when investors invest in equity strategies with an asset manager, the fiduciary responsibility often rests with an active manager. For smart beta strategies, the fiduciary responsibility now rests with the investor because the asset manager is judged on how well they're able to replicate these strategies and keep the replication costs down. So the fiduciary responsibility now rests with the asset manager, and therefore it is very important that the asset owner understands what these risks are. Understanding risks and being able to communicate on those risks with stakeholders leads to better governance practices.
Okay, great. So if I understood correctly, these risks are hidden, but even though they're hidden, they're very important because they have an impact in terms of short-term performance from that point of view. Okay, now you mentioned three risks. Now let's look at each of them in turn. We'll start with the market beta bias. Now, in a long-only strategy, market beta is one.
Yep.
So what do you mean by bias, and why is that important? Yep. How do you correct for such a bias if there is one?
Okay. So that is usually the starting assumption. You have long-only strategies, your market beta is one, but in fact what we'll see that is not really the case. So let's have a look at the market beta bias of these strategies. The reason the market beta is so important is because if we do a performance attribution and a risk attribution of a multi-factor strategies, as we do here using some long-term US data, if we look at the performance attribution, what we see quite clearly is that the market is driving most of the performance, much more so than the factors that we are trying to get exposure to. So having any biases in the market beta is going to make a big difference in terms of performance. And even more so if you look at the risk attribution, the volatility attribution of a multi-factor strategy, clearly most of the risk in long-only strategies is still the market risk. The factors themselves have actually quite low risk. So any biases in the market beta or the market risk is going to have also a big impact from a risk perspective. And looking at this slide as well, on the far left-hand side, we can see what one of those biases are. When we do an analysis of the factor exposure of a multi-beta strategy, what we see that typically the market beta of a strategy is around about 0.84. It tends to be less than 1. It tends to be somewhere between 0.8 and 0.9. So you are not getting a full access to the market risk premium, and you tend to have a defensive bias when you invest in multi-factor strategies. So that's a first important observation, is that the market risk is important and you tend to have a slightly defensive bias. Secondly, in addition to having a defensive bias, if we look at the market beta of individual factors through time, and here we show in this slide how the market beta varies across 6 different well-rewarded factors, we see that there is also a lot of variation over time in the market beta. So the starting assumption that in a long-only strategy your market beta is 1 clearly isn't true, that the construction of these factor portfolios leads to a variable market beta over time. And this variable market beta and this defensive bias can lead to very different performances in bull and bear markets. So in this table here, again, we summarize the performance, but this time splitting up the performance in bull and bear markets. We use some quite long-term US data spanning 40 years. Again, we look at the performance of individual factors in bull markets and in bear markets, and we can see that there is a considerable difference across each factor in terms of the performance in a bull market and in a bear market. And on average, on the far right-hand side, what we note is that in extreme bull markets with this defensive bias, these strategies don't perform as well as they do in bear markets. So this defensive bias is also going to condition the performance in bull and bear markets. Now, we can really get to understand what these market biases are by looking at the performance of these individual factors. Instead of looking at long-short portfolios, we look at strategies that are beta neutral. Simply in the first table that we show, the dollar neutral table, you may have a variable market beta. So if we actually adjust the strategies to have a 0 market beta, what we observe in the table below is that the actual factor premium that are delivered are actually quite stable and quite steady over time once you adjust for the market premium. And we see on the far right-hand side, you get just as good a performance in a bull market as you do in a bear market. And a lot of the variability that we showed earlier is simply driven by these market beta biases. So what can we say about what the biases are in terms of the market risk? Well, there are 2 biases. The market beta tends to vary over time if left uncontrolled, and tends to be lower than 1. And what are the implications of these biases? Well, if you have a market beta that is below 1, you'll be missing out on part of the long-term risk premium of the market itself. If your market beta is 0.84, you're going to be missing out on 16% of the long-term market risk premium. But obviously, you also have lower risk. And also having a market beta bias, clearly, as we saw in the previous slide, leads to pronounced differences in different market conditions. If somehow you can adjust for that, you can get more stable factor returns across different market conditions, bull and bear markets. So that is why it is important to also think about making a market beta adjustment. What we've observed is that the market beta tends to be below 1 and it varies over time. So we have developed techniques to be able to measure what the market beta is for a particular strategy. Once you know what that market beta is, what you need to do is you often need to leverage that portfolio to bring it up to a market beta of 1. You need to adjust it. So there are two ways you can adjust it. One is through simple leverage. Leverage the portfolio, borrow and reinvest in the multi-factor portfolio until you achieve a market beta of 1. The second way you can leverage up your exposure to the market is through an overlay strategy where you invest in a small number of futures. Futures give you a leveraged exposure to the market, and you can adjust your market beta through this overlay strategy. So this adjustment provides not only full access to returns, but also will provide you with higher risk as well.
Okay, great. So that correction that you make is done either via leveraging or using an overlay facility, as you just mentioned. Okay, so well, that's the market beta bias comprehensively covered. Let's talk about the second risk. You talked about sector risk. What exactly are sector risks and how do those impact investors? Why are they important?
Okay, so sector risk. In terms of sector risk, smart beta strategies, at least the way we design smart beta strategies, multi-factor strategies, our objective is to design a strategy that gives you a long-term, a high Sharpe ratio over the long term. Now, in achieving that objective, you're going to get differences in terms of sector exposures, sector biases. So in this table here, we show you the average exposure over a long period of time of a multi-factor strategy, and we also show you the sector weights of the standard cap-weighted index. And by looking at the difference between the two, we can observe that there are differences in terms of sector exposure, at least compared to the cap-weighted index. So by sector bias, we are talking about the bias relative to a cap-weighted index. Now, in terms of the biases this can have, the sector biases can have in terms of short-term performance, we can illustrate that here, and we can see that quite clearly by looking at the top table. So if we look at the performance of a low volatility strategy in 1999, that was the peak of the technology bubble. So what we can see there is that the technology sector had a very, very strong performance, an annual performance of 77%. And a low volatility strategy, which tends to be underweight the technology sector, therefore underperformed the market simply because it had a lower representation of the technology sector. So without making any sector adjustment, the standard index actually had a negative absolute return and negative relative return, quite a considerable drawdown on a relative basis. Making a sector-neutral adjustment gives us positive returns and quite clearly helps us to reduce some of these negative relative performance effects. So sector biases can quite clearly have, as we saw here in the short term in the technology bubble, can have quite a big difference in terms of performance over the short term. So we need to think about sector risk control. The reason we need to think about sector risk control is because sector risk is an unrewarded risk. Sector factors are not a priced factor. So by taking on sector risk, what tends to happen is you tend to end up having a high tracking error. And this high tracking error, having different exposures compared to the market, will give you a different exposure to macroeconomic factors, which could greatly influence the performance over the short term. So that is why we offer a sector-neutral version of all our multi-factor indices. So a sector-neutral version is offered as an optional risk control. The reason we offer it as an option is because hedging out sector risk has an opportunity cost. Sectors and factors are highly aligned. If you invest in low volatility, you tend to invest more in utilities. If you make an adjustment to utilities, you'll get less low volatility, you'll get less factor exposure, you get less factor intensity. And if you get less factor intensity, it will also reduce the benefit in terms of the long-term Sharpe ratio. So we can see that sector risk does have an influence, particularly in terms of the short term. You can make an adjustment, but that may have an impact in terms of the long-term risk-adjusted returns.
Okay, so essentially for investors, there's an opportunity cost to making an adjustment for sector biases. It's ultimately up to the investors. Now, that's market beta bias and sector risk covered. Let's talk about geographical risk. Do you treat that differently?
Yes. In terms of geographical risks, whereas we provide market beta as an option and sector as an optional risk control in our flagship index, we treat geographical risks slightly different. So what do I mean by geographical risks? I mean exposures that you have that are again different to the market when you come and look at these smart beta strategies on a regional basis. So smart beta strategies that are designed or created through optimizations on an international universe tend to lead to strong regional biases, even though a provider may try to control for those to a certain extent. So in the example we show here, we show the regional biases and the country biases you get by investing in the MSCI MinVol portfolio. What we can see here, we have some relative sector allocations. We have some allocations that are different relative to the cap-weighted index when you try to create an international portfolio in this way. Now, taking macroeconomic risks on the basis of academic reasoning and proofs that correspond to microeconomic factors, value, momentum, are microeconomic factors, it makes absolutely no sense to take macroeconomic factors using microeconomic factors. So that is why at Scientific Beta, what we do is we create our factor strategies within regional blocks, and then in order to avoid taking macroeconomic risk with these micro factors, we simply neutralize those geographical risks by weighting the regions in line with the cap-weighted index. It makes absolutely no sense to take macro risks using micro factors. These macro geographical risks are an unrewarded risk. So Scientific Beta, by design, hedges out the regional risks, the large macro risks, but Scientific Beta also offers some risk control in terms of country neutrality. Country neutrality is an important thing to look at when it comes to investing in emerging markets. In emerging markets, the typical regional approach in emerging markets uses countries that are not economically integrated, and therefore it is worth also thinking about applying country neutrality within emerging markets. And again, applying country constraints has an opportunity cost. It constrains the strategy and therefore also leads to a reduction in terms of the Sharpe ratio. So in terms of country risk, what we look at here is a low volatility and a value strategy. Here we have region neutrality in our standard product, but we don't have country neutrality. And as we can see here, the standard index that doesn't impose country neutrality tends to have quite a high tracking error. So by imposing country neutrality, you can see you reduce your tracking error, and the reduction in tracking error leads to higher information ratios. But this adjustment, this country adjustment that is applied, tends to lead to a reduction in the Sharpe ratio, as we can observe as well through the geo-neutral versions that also impose country neutrality as well as region neutrality within these strategies.
Okay, well, that's a nice overview of all the three implicit risks. So how about you give us some concrete examples of how, when you apply these controls, what effect does that have on performance? What does that look like?
Okay, so we've discussed what the implications of what the risks are and what the implications of those risks are. Let's now put all of that together and try to understand what it means in terms of performance. So let's start off with our standard flagship multi-factor index, and we will look at this using our US long-term track records, which is based on 40 years of data. Now, looking at these results here, we observe that our reference cap-weighted index, which is made up of the 500 largest, most liquid stocks in the United States, has a Sharpe ratio of around 0.35. Now, remember, I said that our strategies are designed in order to improve the long-term Sharpe ratio of using our multi-factor strategy. And what we can see here is that there is an improvement from 0.35 to 0.63, something like an 80% improvement in Sharpe ratio when you are exposed to risks that are well rewarded, and also diversify your strategy and diversify not only the stock risk but also the factor risk. It leads to high Sharpe ratios. Now, our standard multi-factor index, which doesn't have any risk controls, tends to come with a volatility that is lower than the market and is able to achieve a return that is higher than the market. So this strategy is a very good strategy to use to replace the cap-weighted index. You can have lower risk than the cap-weighted index and over the long term deliver better returns than the cap-weighted index. So we think of our strategy without risk controls as a replacement for the cap-weighted index. Now, this replacement for the cap-weighted index means you're not going to measure the performance relative to the cap-weighted index. If, however, you are concerned about relative performance to the cap-weighted index over the short term, you can apply sector neutrality. And what we can see here is by applying one of these risk controls, sector neutrality, you can reduce your tracking error quite substantially, and that leads to higher information ratios. But as we pointed out earlier, this sector constraint will also have an effect in terms of long-term Sharpe ratio. We designed the strategy to have a high Sharpe ratio. Constraining the strategy leads to a reduction in terms of Sharpe ratio over the long term. So that is the impact of sector neutrality. Now let's look and see what happens when we apply our market beta adjustment. So in terms of market beta adjustment, we adjust the strategy to have a market beta that is in line with the cap-weighted index. So the idea is we design a multi-factor strategy that is completely independent of the cap-weighted index, but now we're concerned about relative risk, so we make an adjustment to align the market beta of our multi-factor strategy to the market beta of the cap-weighted index. Now, what we observe here is by making this adjustment, we use leverage to make this adjustment. Leverage doesn't impact the Sharpe ratio. So we observe that the Sharpe ratio is the same for the market beta adjusted strategy. But where it does make a difference is in terms of return. So in terms of return, you now have higher return because you're more exposed to the market. You have a greater exposure, so you pick up more of the market risk premium, but that comes with a cost because you also have higher risk. The Sharpe ratio is the same. You get better return, more market return, but you also get more volatility, and you get just as much drawdown in terms of when you have a crisis. But in terms of return, you can see you get a substantial lift in terms of return. about 4.5% outperformance compared to the unadjusted strategy, which tends to have an excess return of around about 3%. So what is the benefit of this approach? Well, the idea here is that when you want to replace an active manager who you give a mandate to try to outperform the market on a regular basis, then making this market beta adjustment is a relevant thing to do because it gives you much more even performance across bull and bear markets. If you look at the bull market performance, the relative performance in bull markets and bear markets, you actually see outperformance in both market conditions because you've aligned the risk of your multi-factor strategy with the market. So the market beta adjustment is something that is worth considering if the investor is looking to replace an active manager. And of course, by making the market beta adjustment, if they want even more control in terms of relative risk, you can also add the sector neutral adjustment to that market beta adjustment. And that's the strategy that ends up having the highest information ratio. But obviously, making this sector adjustment leads to a slight degradation again in terms of the long-term Sharpe ratio. So if you're really looking to replace an active manager with the best performance, simply making that market beta adjustment is a very, very important adjustment to make. And we also, it's also worth looking in terms of how that impacts short-term performance, because these risk controls, as I said earlier, will impact short-term performance. So we also look at shorter-term performance over the last 10 years by looking at annual performances using these risk controls. So the strategy that doesn't have any risk controls, we show it for a US multi-factor index and a developed world multi-factor index. What we observe over the last 2.5 years is that a multi-factor index has underperformed the cap-weighted index. Now, if we make that sector adjustment, we can actually see why this strategy is underperformed. It's because it has differences in terms of sector exposures. Once you make that sector adjustment, you hardly get any underperformance at all. So it isn't so much driven by the factors, it's more driven. The recent performance has been more driven by sectors, which is why it's important to look at these implicit risks. And if we look at the third column for each strategy, what we see is once you make that market beta adjustment, clearly that has a very, very big impact. So in fact, the performance without risk controls recently has really been driven by the fact that you don't have full exposure to the market. It's not necessarily driven by the factors, it's actually being driven by the market beta bias of these strategies. So investors need to think really carefully about what is it they're trying to achieve. Relative performance relative to the market, or they're looking to replace a cap-weighted index with lower risk, in which case you will get some underperformance in the short term when the market is very, very strong.
Okay, great. So what then are the key takeaways for investors who are looking to allocate to these strategies?
Yeah, there are three important things to bear in mind. Hidden risks, undocumented hidden, we call them hidden because they have not been well documented. So these hidden or implicit risks are a very important driver of short-term performance. So instead of simply looking at the returns, I think it is more important to understand what these hidden risks are, because they will help you understand the recent performance. So looking at recent performance is not enough. I think you do need to look at these hidden risks and think about what the adjustment has had in terms of impact on short-term performance. Smart beta strategies also need to disclose and offer innovative solutions to adjust for these implicit risks. That's exactly what we do. We provide risk controls so that an investor can find the right strategy for them in terms of their fiduciary responsibility as well. This is very important because it is the investor that is making that decision. The asset manager is simply replicating that strategy for them. So therefore, the key fiduciary responsibility rests with the asset owner. And it's important that they understand what these implicit risks are, and for us as an index provider to offer them controls to be able to adjust the strategies in line with their fiduciary responsibility.
Okay, well, that's about time up for today. Thank you as always, Eric, for your useful insight.
Thank you, Dami.
So that concludes today's webinar. We hope you found Eric's presentation interesting and informative. For more detail on the subject, we have published a white paper which is entitled Misconceptions and Mis-Selling in Smart Beta. So you can find that on our website, www.scientificbeta.com, and we will also make the slides in this presentation available to you in due course. In the meantime, if you have questions, feel free to send them to us to webinar@scientificbeta.com. And lastly, please remember to follow Scientific Beta on LinkedIn and on Twitter. You can also consult the Smart Beta Solutions channel on YouTube, where you'll have access to all of our webinars. So thank you for watching today, and goodbye.